I want to give you a breakdown of how I took a portfolio of $2.4 million, I helped them lower their taxes, and gave them the best secrets that I know that can help you lower your taxes in retirement as well, no matter if you have far less in retirement or far more. The first is how to be like Santa Claus and save taxes while being generous. The second is how a Roth can help you or hurt you in retirement. Medicare issues that you need to know because these things are contributing to your tax base. And when you do something is just as important as what you're doing. Hi, my name is Michael Solimanto. I'm an enrolled agent by the IRS. It's the highest credentials the IRS gives on taxes. And this is a really fun subject for me because I'm telling you, many of you are missing out on some of the incredible benefits when it comes to lowering your taxes. This video is not about how to just do a Roth conversion, but a Roth can be a great strategy, especially for higher net worth individuals. So let's start by saying that with a Roth and what a Roth actually is and how they actually help. And also, if most of your savings are pre-tax, especially in your 401k or your IRA, you're going to have future tax problems. Now, they may not be big problems, but they may be a problem, especially for your heirs, and that's not a well-considered thing. Because every dollar that you take out in retirement is taxed unless, of course, it's under the standard deduction or your itemized deduction, but everything over that is going to be taxed. So by converting some of these funds from your IRA into a Roth, what you can do is you can find a tax arbitrage, a soft spot, where you can find low income years, convert those years into Roths, especially if you can fill in multiple brackets. You can find that a Roth can actually help you save taxes in the future because the brackets are going up in 2026. Now, this may not help you if your portfolio is under 2.4 million, but this is a great way to start thinking about how to, especially if you're over 2.4, this is almost a necessary evil because taxes right now are going to go up in 2026. But here's the kicker. It's when you time your conversion, because the timing is the way you minimize that tax burden. You just don't want to throw too much money into a Roth because it's going to create future problems. So when should you start thinking about doing a Roth conversion? Well, typically at 65 and older, you may have missed the window because if you do Roth conversions then, you will more than likely, especially for the higher net worth individuals, trigger your IRMAA taxes. Now, this may not be the biggest deal, especially if you're only triggering that amount of money in the lower echelons of IRMAA, but it's definitely a consideration because once you trigger IRMAA, there's a 2-year look-back window that they'll charge you. Now, there's a way to get around if you're having so much income and you retire, but not true with a Roth conversion. So, for example, if your income will trigger IRMAA taxes because you're working and you retire, that's not an issue because there's a form you can give to the IRS and you can say, look, I'm no longer working, my income went down, this is no longer true. With a Roth, that can be far more complex because we're not talking about income, we're talking about conversions. So you have to be careful about looking at this. But then, of course, you have to look at when your RMDs kick in, because maybe the other side of it is if your RMDs kick in and that triggers IRMAA, you're almost in a no-win situation where all you have to do is focus on what is the lowest tax bracket I'm going to be in and look at an overview of what is going to be your taxes over a 10-year, 20-year window, and that's going to give you a better picture if a Roth timing is right for you. The next component is figuring out how much income you need because obviously if you need less income, you can do a higher conversion into a Roth IRA. If your income needs are higher, then that can become more problematic when it comes to the timing or how much you can actually convert. These are considerations. So this way, it's important for you to take like a big spreadsheet or a pen and paper, write down all of your expenses. And sometimes it's hard to do because what I found over time and just dealing with a lot of people is they typically undervalue what their income needs are. And this has been a consistent theme. So I would recommend you write down all your expenses, you write down your mortgage, you write down any kind of healthcare expenses, your travel, especially future travel, especially if you plan on traveling a lot, any kind of unexpected costs. Now, I figured for many people, this might be the simplest solution. For higher net worth individuals, they typically want to retain close to the same amount of income as they had when they worked. So ask yourself this question. If you were still working, how much did you save? Well, if you didn't save much money and your income needs are high and you think you'll have the same exact income needs, that's probably a good place to start. Now, of course, as you're aging, some of those expenses will just fall off. Like, for example, if you have a mortgage, more than likely, it's going to be ending a lot closer in your retirement years than when you're older. That's typically the way that works, but you have to start figuring out a baseline of income that you believe is going to be stable for you moving forward. The other thing is where are you pulling the money from? If you look at it from an overall perspective, it might be better in the first early years of retirement to withdraw money from your taxable account. So any kind of brokerages you count of money that's already been taxed, that might be the best place to first withdraw money. Now, I'm not talking about a Roth IRA taking out. I'm talking about a regular brokerage account in money which has already been taxed and in a brokerage. This could be the first place to withdraw from because, again, we're leaving some tax considerations on the table. There could be some other considerations too. Like, for example, in those accounts, there's a step up in basis. Now, if you don't know what that means, it means that when you pass away, whoever is going to inherit that money will receive that money tax-free. So if there's a legacy play here, you may want to focus on the step up in basis on the stuff, on the equities that you've already paid taxes on, because that might be the best way to give money to your loved ones. And I promise you this wasn't all about Roths. Another thing you can do is if you look at money that's already been taxed, any kinds of assets when it comes to either your home or stocks, and you're looking for a way to take out some really tax efficient money while also thinking about how you could give at the same time. There's another way to give money that's like Santa Claus. I haven't gotten into that yet, but this is called a charitable remainder trust. Not well understood. You can find it right in the IRS tax code. It is a bit complex because you can take your money out in multiple different ways. It would actually need a whole separate video on the power of a charitable remainder trust. And what this allows you to do is it allows you to take your assets, whether it's going to, now this is only taxable assets. You cannot do this with pre-tax assets. I think that right now the IRS gives an exemption up to $50,000 in doing this from anything that's pre-tax, but anything over $50,000 will not fall into this bucket. So you have to be really careful. This is not made for pre-tax qualified funds. This is for money that's already been taxed. So what you do is you take your assets, whether it's a home, stocks, business, whatever it is, and instead of you trying just to figure out some way to lower the tax, you can actually give the asset into the trust. The trust then will take the asset, sell it. And here's the power of it. They're going to give you a deduction up to 30% of your adjusted gross income that you can apply for the first 5 years. So think of it this way. Let's say that you have roughly $500,000 in post-tax accounts, $500,000. You take that stock, you put it in the trust, you sell it. There's no taxes on that $500,000 in that sale. If it wasn't, you typically pay capital gains, or if it's less than a year, you're going to pay ordinary income tax. Well, in this scenario, when you put it in the trust and the trust sells it, there's zero tax. But you want to draw income from it. And the way you draw income, and this is the flexibility of a charitable remainder trust, this is why it would just take so long to explain. There's typically the two most common is a CRAT, a charitable remainder annuity trust, or a CRUT, a charitable remainder unit trust. The unit trust is far more flexible. It gives you far more flexibility than doing the annuity trust. It just depends on what your goals are with the money. But here is the secret sauce that people, I'm sure you've never heard of before. Now, whatever income you're drawing from that trust, you can take out for the first 5 years, basically tax-free, up to 30% of your adjusted gross income. Now, all you have to do is you have to allocate 10% of intent to some charity. Now, that's intent, because if you spend out enough money, I've seen it to where you basically give almost nothing to charity. Now, this is kind of undoes the charitable side, but it's to how you can do it legally as well. So again, you can pledge to future tax years and then look at stretching out the first 5 years tax-free. Pretty neat trick. Again, this would take a full video. I'm giving you like the 5-second version of this. Another way to use Roths is to use what's called a tax valley. And where's that tax valley? It's the retirement before you start drawing Social Security and you're in lower income years. And by doing this, these are your golden years for converting into a Roth because you're in that lower bracket and you can fill it up. I prefer, instead of calling them tax brackets, tax buckets, because you can fill those buckets to the top at that level of income that you know is going to be your lowest bracket, especially when looking at further considerations. It's very important to do this. Now, what this is going to do, again, is this going to help you lower your RMDs in the future as well. So by doing this in those lower years, what you're going to do is you're going to lock in those taxes in those lower years. Now, another technique, and these are all suggestions, they're not telling you what to do, The next one, which you can do, is you can talk about the timing of your Social Security benefits. If you find, and this could be a benefit for you, to delay your Social Security up to the age of 70, which is the max amount of money you could get, you can then take those lower income years and actually start drawing from the Roth conversions if it's been over 5 years. And what this is going to do is allow you to take that income out tax-free, because once Social Security kicks in, there is the provisional income tax, which is super confusing. And it can add an additional tax burden, especially when you start triggering RMDs. So delaying Social Security can give you a way to help you lower your taxes in the future. Although for many people, I don't know if it's necessarily the best course of action, because I find that Social Security, well, they keep increasing the age of full retirement age. So this is a tax strategy, but it's not necessarily an income strategy. Now we have to think about Medicare tax. It's called IRMAA. It is a serious pain in the neck. I think it's completely unfair. You paid into Social Security, you get the money back, and then you have to pay extra money into Social Security. I mean, it's insane. But anyways, you have to factor this in, because if your RMDs start triggering this or your extra income starts triggering IRMAA, it can become a spiral that just gets worse and worse, especially if you're a higher net worth individual. IRMAA taxes are real and they can get pretty hefty. We're talking $450 a month in extra tax just on your Part B. That's not even considering your Part D increasing. So there's some ways for you to start looking at this from when you need to time your money to avoid. This is where a Roth can be very helpful. A charitable remainder trust can do it. And I'm also going to give you another strategy. Again, we're going to get into the Santa Claus method shortly, but all these methods come together to help lower your taxable base and help you have your retirement in better. So let's talk about the Santa Claus method, shall we? There is a way to give. I don't necessarily want you just taking your money out of your pocket or writing a check to charity. It's far better to use a qualified charitable donation, which means that the money goes from your qualified funds that are taxed to the charity. Now, this does a few things. One, you're not paying any tax on that, therefore you could give more overall dollars to the charity. Number two, it will lower your RMDs in the future. This is why there's two ways to give to charity, either through a qualified charitable donation or the charitable remainder trust that helps you lower your taxes. This could also be true when you think about how much money you give to charity, because you can exempt up to 60% of money if you're doing itemizations on your taxes. But even though all of this is the best information today, just bear in mind, things change. They change the tax laws all the time. As a matter of fact, even the laws for Roth IRAs have changed. It used to be that you could self-direct your own Roth IRA. You could still self-direct it into stocks, but you could not self-direct it into your own companies, because Peter Thiel turned $2,000 into $5 billion, and they panicked and changed the tax law. So you have to be flexible. There has to be some degree of mental flexibility on what the best strategies are moving forward. That's why I suggest making sure that you get the best tax information possible from people who specialize in retirement tax planning. And they should be a tax planner, not a financial planner, because taxes change so much, so frequently, that I have to do 2 hours every single month learning taxes, getting brain damage. So my biggest takeaway for you is to maximize your tax efficiency with a very good plan. You should think about how you can look at your tax brackets. Again, think of them more as buckets, how you can fill those buckets, the timing of when you do it, what your conversion strategies are, if at all, and the importance of tax planning and making sure you have a holistic perspective on what's best for you. Now you can go to our site, Golden Allies. I can help you with your taxes, but we have a lot of great videos that can help you. But I'm going to give you the other side of a Roth that no one ever tells you. So if you're pretty much under $2 million, we're going to go through those big problems of the Roth right now.